It's time now, though, for Futures in Focus. Oil on track for its largest weekly decline since May as emerging markets continue to weaken and US crude inventories expanded. Let's bring in Bob Iaccino, Chief Market Strategist at Path Trading Partners. So, Bob, what was the most interesting movement for you this week in the markets?
I think the failed rally that we got a couple of days ago off of some more geopolitical tensions, as well as the draws that we saw in crude oil that caused that, I think that failure was critical. We have a situation in commodities that you don't necessarily look at as much in other asset classes, where seasonality is a huge factor. And the strongest seasonality we see is in copper, natural gas, and crude oil. That crude oil seasonality is taking over right now.
All right, you're looking at the dollar real quick. We're about 95 on the DXY. What's the level that you're looking at where you see maybe a little bit more either resistance or the potential for a breakout?
Well, you've got a 200-week moving average. It's about a $0.50 higher from here. Until we get a weekly close above that, I think they'll probably still sell rallies, but the jobs number is going to be the deciding factor. We saw the wages, so we're probably jumping above that in the next 10 days or so.
Bob, let's talk about gold, because we've been sort of fluctuating below and above $1,200 an ounce. What happens next?
I just don't see a reason to own gold at this point. I still think it's a valuable asset long term. I'm not knocking gold bugs. But to me, you have to have a serious geopolitical issue to get those sharp rallies that we're used to and seeing in the yellow metal. We're not seeing that. And the crises we've seen, you can't really call them a gold crisis. Gold didn't rally over Turkey much, isn't rallying over the spread between Italy and German bonds much. So it's just not reacting in the way that it used to. That tells me that these crises, that's not the right word for it.
When we look at the reaction to the jobs report today, this is the first day in a while that I've heard people talking about 3% on the 10-year. Again, we sort of forgot about that. Is this going to embolden the shorts?
I think so. I mean, what we saw with the wages today was telling, although you have to keep in mind how slowly they did rise. I think there's a relationship there between how slowly the wages rose and whether or not they're going to hit inflation at some sort of faster speed than they did with the wages. I don't think they will. So I think 3% is definitely in play. You're probably looking at 3.5% at the end of 2019, but that's a stretch for most people to think about at this point, except Jamie Dimon.
An extra special treat to have you in studio with us today. That's Bob Iaccino of Path Trading Partners. We typically speak to him at the CME. This is Bloomberg.